So, when you're looking at price exit risk management rules, these can be very, very subjective and really depends on a number of factors. So it's going to be very dependent on your trading account. How much capital are you employing in your trading account, and how much risk, how risk tolerant you are. So are you very aggressive as a trader or more conservative? So you have to kind of put together your own trading plan to answer those types of questions. And then the other thing too is time to trade. Are you full time or part time? Are you going to be monitoring the markets all through the day, in the morning, afternoon, midday? So these are all things that you want to factor into your trading and to your trading plan. Now, stop loss, just try to put together some simple rules there. So, one thing I always like to look at is to base, if I'm doing a swing trade type setups where we're basing it on a daily time frame as the anchor, then I will look to use the daily time frame. A lot of times I like to use that 8 exponential moving average or the 21. Now the 8 EMA is going to be the fastest. So, if you want a faster stop, I'll use the 8 EMA, and a lot of times it'd be like a close, on that 8 EMA or below it, something like that. Or it could even be just an intraday. So, you've got to be a little bit subjective there as well. So I usually use that 8. Or it could be the 21. So you just have to look at the chart point, see what makes sense for your trade and to the amount of risk that you want to take on that trade. So close below or above. Now, also if you're using a little bit of faster time frame, so let's say we decided to go with the 4-hour time frame, wanted to be a little bit more aggressive, then I would use the 4-hour time frame as that stop loss. So, a close below the 8 or the 21 on the 4 hours. So whatever time frame you use to open the trade, it's best to take that same time frame. Or the other way, if you use a daily time frame to put the trade on and you want to be a little bit quicker on your stops, perhaps sometimes you can use the 4-hour time frame, which will be a little bit faster. Other thing to use, you could look at the Parabolic Sar. If that flips, that would be also a stop out that you could use. And again, you could use that on a faster time frame, like the 4 hours, something like that. Or a trend line break. So those are the basic type of 3 things that you can look at for stop loss. So here's an example. Here's gold, really trading hard to the downside, and here's just a kind of a profit stop. You could have just stayed in that until that trend line break, and be out right there. So here you could have. That was also a potential swing trade. Cycle low reversal trade entry, but that could have also been a trade exit, if you've been riding this thing short all the way down. So you can see the Parabolic SAR flip there, so that could have been a stop. So a lot of different ways, to implement your risk management plan.